So I get a lot of calls from representatives and even clients right now asking, and they're concerned because of all the market volatility. And, one of the things advisors have to be aware of is their client's individual situation. Of course, I'm not telling an advisor anything new about that. All advisors know that they have to know about an individual situation. But what I find is really helpful when talking with clients in market volatility is, number one, to go back to take a look at their risk profile first and foremost, because a lot of times clients will call and they'll say, the market's so volatile, I'm losing money. Why are you losing your money? And I'm like, well, first of all, before I answer that, let's just go back and make sure that your risk profile is in line with where you're supposed to be. And that's always the first starting point. Once we get the risk profile, then we can come back and take a look at the portfolio and say, okay, either you're in line with it or no, we need to make adjustments. And if they're in line with where they should be and they're still concerned, now we know there's a problem as far as education goes. So it's a matter of rebooting, coming back to the beginning and saying, okay, let's revisit why we're doing what we're doing and make sure that how you're invested is supposed to be the way you're supposed to be invested for your own situation. One of the big reasons that I went independent and I got away from the large firm concept and the mindset of going independent is because I wanted more freedom and flexibility, not just for myself, but for the clients that I work with. I know that the industry tends to talk about investing in a box a lot of times, but when you become independent and you open your mind to possibilities, you quickly understand that there's so many different philosophies out there. You have your traditional asset allocation style of investing, which tends to be very passive and low cost and focus on diversification. But then you have another investment style out there that says, maybe it's not the best time to be fully invested right now. So as an advisor, when I'm talking to clients, when I'm talking to you, I want to make sure that my clients have all of the choices. I'm not a product salesperson when I talk to a customer. And none of our representatives are product salespeople. We're literally coaches and advisors trying to solve a problem for our client situation. You see the volatility right now in the markets and things are swinging crazy in the news. They're going nuts, right? Everything, the one side and the other side, doesn't matter if you're Republican or you're Democrat, they're all trying to manipulate, I guess is the right word for all of us. So in a situation where right now we have a lot of volatility in the markets, again, it's going back to day one and revisiting your individual risk profile, your suitability needs, exactly where should you be and how are you invested currently? Do those two things match up? But then with the way that I think, it has to go deeper than that, because now we're talking about, okay, the risk profiles align with the individual, the profiles align with the risk profile. What philosophy of investing do we use for that client now? And that's where we're different, because the typical industry advisor is talking about asset allocation, broadly diversifying a portfolio across all asset classes. And that's fine. So that's our Vanguards and our Fidelities and our T. Rowe Prices. And if you have a Merrill Lynch advisor or Morgan Stanley or Edward Jones, the philosophy is, let's invest the client portfolio, broadly diversify it, but don't ever sell it to cash. Maybe rebalance every once in a while, change a few things. So when we dig into a client's portfolio, we start thinking about it, we understand that there's one philosophy that dominates the industry, which is the Vanguards, the Fidelities, the low cost, the low fee thinking. And that's fine. That's certainly a strategy. But there are other philosophies out there as well. Beyond just investing and buying it and holding it. So there's another philosophy out there that says maybe we second guess the markets today. And maybe we move things around a little bit to react to current market condition. I get asked a lot, are you able to time the market? And I say, well, no, market timing is, as the industry even says, pretty much impossible. But the way that I think about investing is if you're the type of investor that thinks you want to move through the market and change as the market changes, why can't we change as we see data coming in and we see things changing in the marketplace? Why can't the portfolio change along with that? Why does it have to be this rigid structure? So part of our job as a coach, as an advisor, is to educate our clients on the various styles. You have your low cost asset allocation. You have a style that attempts to move through the markets, to navigate through the market, not trying to beat the market, but to navigate it. And then lay those options on the table for the client and see which one aligns best with their goals. So I had a call this morning. He said, I've had, with this volatility in the markets, it very concerning, and my phone's blowing up. And I thought, well, maybe, but we have 80 advisors at our firm, and you're the only one that's calling right now concerned about it. So I think, well, there's got to be another issue here. So I dug in and asked some questions to him. I said, look, what's the concern and where's the problem? Where's the issue? I want to get to the root of it. He sent me an email back and he said, okay, client number one, I took care of it. I've known him for a long time, and it's just a matter of touching base with him again. Client number two ended up moving to another firm because they took a look at one day of how we were invested in the past, and they assumed that that's how we always be invested. And my answer to that was, well, that's a problem, because the style that the client chose was one that doesn't always stay the same all the time. If you look at a portfolio that is an actively managed portfolio that moves in and out of the market, to capture one day and to make an assumption based on one day in the market doesn't give you the whole picture of what the goal of the portfolio is. The third scenario was the client was more concerned. She said, okay, the performance is lagging and the fees are high, so I need to come back and revisit. And my answer was, let's go back to the very first day and let's reinforce why the client chose what she chose. Matter of fact, in that case, the client chose at the time to manage the risk in the portfolio, which means moving in and out of the markets. It's not about performance. This is about activity. This is about reacting daily sometimes as changes happen in the marketplace. And as you know, over the last month, the market's changed quite a bit. In that case, I went back to our representative and I said, look, this is how you explain it. It's a matter of revisiting exactly what you wanted in the first place and reinforcing why you wanted it. But then having the risk profile retaken to make sure she's still in line, and then reoffering her different philosophies to make sure, because if it's about fees, then there's a solution for that. If it's about moving through the markets and trying to navigate risk, there's a different solution for that. So it's a matter of communication a lot of times with clients. Look, at the end of the day, there's nothing wrong with your traditional asset allocation models, like your Vanguard philosophy of well-diversified portfolio across large cap and mid cap and small cap, and against international markets in various sectors, and just broad diversification. The concern from my standpoint right now is that when we look at the market itself and we ask the question, is the stock market expensive today? The answer is, by a lot of variables, yes. We know the stock market is very expensive. We can turn on the news and we can hear that. But we can validate that through a lot of other financial metrics as well, that things are really expensive right now. So it tends to put people in a bind that only understand one philosophy of investing, that focus on that one philosophy. So the idea is, as an investor, is you have to be able to open up your mind a bit and step away from the narrative of the industry and look at all of the choices. If that's a concern, that the market is too expensive right now, I mean, imagine if you lose 50%. Is that good or bad or right or wrong? It depends. It might not be bad. It might not be good. It might not be right. It might not be wrong. Each individual has their own scenario they go through. Do I want to lose 50% for my clients? No, I honestly don't know how I'd sleep at night. In my mind, I want to be able to make sure I do whatever I can to protect the client's downside. But not all clients want that style of management. Maybe they don't want to pay the fees for it. Maybe they don't like the activity. Their CPA doesn't like all the trades. They'll say it's churning. Well, we're fee-only advisors. We don't make money on trades. Our job is to work with a client and make sure that they are allocating the right way per their risk tolerance and their philosophy. And that's how we do it.